In the first two videos, we talked about market performance on a year-to-date basis, and we talked about today's events in historical context. In this final video, I want to go over investing in uncertain times and the psychology of it, and what we can do to improve the implementation of our financial plans and our investment plans. So obviously it goes without saying, there's a lot of uncertainty in the world right now, whether it's the bank failures, whether it's politics, whether it's geopolitics. A lot of our clients are scared, and last year the markets were certainly very bad. So this roller coaster ride persists in perpetuity. And what happens is, when things are really good, investors get confident, they start buying into the stocks, and then when things start to go down, they get scared and say, oh my God, the market's going to go down forever. We need to sell before things get worse. So in 2022, we saw people abandon stocks. We saw people abandon bonds as they got into this defeated trough. Now this year, as stocks have gone up, the S&P is up roughly 7% on a year-to-date basis. Interest rates on the long end have started to go down, and so bonds have started to come up. People are generally considering this a dead cat bounce. They're certainly not into this positive or confident phase yet. But as the markets continue to go up, if the market continues to climb, eventually they will get to a point where they say, all right, everything looks good, it's time to invest again. And that's when the market will go down, and they will continue the cycle of buying high and selling low. Our job as investment advisors is to keep investors from doing just that. So one of the things we do to improve the implementation of a portfolio is to maintain diversification. So when I say maintain diversification, in this case, it's looking at large cap stock, mid cap, international, small cap, emerging, 25% US bonds, 15% high yield. This allocation is somewhat arbitrary for the purpose of this illustration. Everybody's allocation will be different. But what this is telling us is that even though diversification does work, it never really feels good. So in this period, 2000 to 2002, when the stock market was way down, we still lost money. Diversification didn't mean that we were going to avoid losses entirely. In 2022, when the market was down, a diversified portfolio still lost 15%. As an investment advisor, I can go and say, hey, we beat our benchmark, but beating the benchmark doesn't really matter. Nobody's giving me high fives if we're still losing 15%. And so despite those trends where sometimes the market feels like it's kicking our butts, other times it feels like we're still losing money, over time, when implemented over a course of years or a span of an entire retirement, what we find is that diversification still works. You will still have some level of outperformance relative to just going with the S&P 500 by itself or choosing a single investment. Same thing with right now, for example, I talk to a lot of clients that just say, let's load up on money market funds or short-term CDs or these things that are doing really well right now. But the problem is, as markets change, interest rates go back down, money market funds start paying zero again, short-term CDs mature, and you have to roll into something else. The question is, where do we go from there? Are you going to go back into the stock market when it's already higher? Are you going to go back into longer-term bonds when the interest rates are already lower? So ultimately, once you get away from acting on a long-term plan, you're going to be subject to this roller coaster, and you're going to be eventually just set in cash and wait for the pain to get too much, but then you feel like you have to invest, and at that point, it'll likely be the worst time. So again, we don't have to be the smarter than the rest. We have to be more disciplined than the rest. Investing in times of uncertainty requires a commitment to a plan, and you can't be acting based on, or I should say reacting based to every daily headline, because the headlines will be there in perpetuity. Bad things will always be in the news, and the good stuff probably won't make the news, because the good stuff tends to be less newsworthy, but more of little things that happen every day to make the world a better place, to make companies more successful. And that's what we're investing in as long-term investors. We often get asked why we do not invest in individual stocks for the most part, or why we're not stock pickers. Someone will say, all right, we need to be in Tesla, or we need to be in Apple, we need to be in Exxon, or what you name the stock. Well, what ended up happening is over the last 5 years, and this chart is updated through the end of last year, of the individual stocks in the US, 46% of them lost money over the last 5 years. So in other words, if you were throwing darts to pick your stocks, there was almost a 50% chance that the one you picked would lose money over a 5-year time horizon. Whereas if you're using the exchange traded funds, which have built-in diversification, you have a 1% chance that you lost money over the 5 years in those same stock portfolios. So again, the companies that make the news are the companies that are a rocket ship, that $1 stock that goes to 100, and if only you'd own that, you'd be rich. But the same likelihood of owning that company is the likelihood of owning the company that started out at $1 and went to 0. And so again, as investors, one of the things that we can do to improve our long-term returns is not try to pick stocks where the odds of us beating the market are essentially 0. So by staying broad-based, we can improve our returns over the longer term and also make ourselves less inclined to react based on headlines or non-systematic risk, which is the odds that one company does something silly that sends its stock price down. Now, we often have clients that say, oh, but I listened to this expert and this person says that XYZ stock is going to do really good. This is one of my favorite charts because it looks at, again, this is updated through the end of last year, the median annual forecast of the direction of the 10-year U.S. Treasury. And the Wall Street experts refer to the 40-plus financial professionals and professors surveyed by the Federal Reserve Bank of Philadelphia. So these are not Joe Schmo making their predictions on interest rates. These are the people that are paid to make their predictions on interest rates. And the reality is 47% of the time they are correct, meaning 53% of the time they are wrong. So if you flipped a coin to make your interest rate predictions, you would be better off than relying on the experts. So keep that in mind when you're watching something or reading something that sounds really, really good. Like this expert has a very good grip on what's going to happen in the future, because the reality is there are no facts about the future. And no amount of forecasting can change that. Sometimes people can get lucky and sometimes they can get very, very unlucky. They can have a perfect forecast and events that were beyond their control can send a stock or anything else plummeting down. So again, we try not to make specific picks based on specific companies that require very, very specific circumstances to work in our favor. So by staying diversified, we can tilt the scale in our favor and build more consistent plans over the long run. Finally, this video is about the psychology of investing through uncertainty. Sleeping at night continues to be the most important thing in any portfolio. If you are losing sleep over your portfolio, you're worried that your investments are going to do X, Y, Z thing, we can't own those investments, because what's going to happen is inevitably this investment's going to go down in value on a short-term basis. You're going to panic and you are going to sell at the worst possible time. And so we have to make sure that our investments are aligned with our goals, our risk tolerance, and understanding everything that you own, so that when things go down, you understand why they're going to go down. There's no surprises, and you continue to be comfortable realizing that your plans are still on track. That is essentially the whole thing about financial planning, investment management. That's what we got. That's what we're going to go over in these seminars. And I've got this last slide here because, again, we talked about the advent of AI and the companies of the future. And this is not a drawing or a picture. This is from my last slide where we talked about DALL-E 2 being able to generate images of anything you want to see. This happens to be a bowl of soup that looks like a monster knitted out of wool created in DALL-E 2. And so again, the future is very bright. The stuff that we're going to see 10, 20, 30, 50 years down the road is almost incomprehensible in terms of the technology is going to seem like magic, and the companies that take advantage of that are going to be worth trillions and trillions of dollars. And many of those companies may not even exist today. So those are the things that we get excited about as investors. The rest of it, we just manage through it. If you have questions about this or anything else, just let us know, and we look forward to talking again soon.